Can you all hear me?
Yes.
Yes, you can be heard. Yes, you can be heard.
Okay. So you can all mute your mics. Time for question. When we are ready for questions, you can unmute your mic and ask questions. Okay. So please kindly mute your mic. So I want to welcome you all for the day 2 of the 5 days bootcamp, Advanced Quasimodo. So yesterday we talked about market structure and the logic behind QML. Okay. So I believe that we all went back to look at the chart to see how it is formed, okay, to practice what was taught yesterday. So today I'll be talking about liquidity, okay? So first, what is liquidity? What is liquidity? So liquidity is money. Liquidity is money, okay? So take note of that. Liquidity is money. I made an explanation yesterday that you need money to buy whatsoever you want. You also need money to go to the supermarket. You need money to go to the shop to buy anything you want. You need money. So it is money that keeps a state running, a shop running, a business running. So we all need money, all right, to move, all right. For your life to move forward, you also need money. So one has to be liquid. So when you hear the word liquidity is all about money. So I wanted to understand that. So this is just the basic, the foundation. Liquidity is money. So in the Forex market, as regards market structure and the Forex market needs money to move. And I said something about market structure yesterday, that the formation of structure is as a result of the movement of money from one location to the other. So if you grab that statement, then we are good to go. So money moves from one point to the other, forming liquidity. So the traditional or the normal liquidity that we know, okay, let's say the fundamental of liquidity that we know is the double tops and the double bottoms. So for example, we have the double bottoms, things like this, okay, and the double tops. So usually it is being said that traders who trade using support and resistance do place their orders at these points at the double bottoms for a buy order. Okay. And they also place their sell orders at the double tops. So the market makers usually in their way of trading or clearing out uses the buy stops or the orders that were placed by these support and resist traders as fuel to move price to different direction. For example, the market makers, the institutional traders are going to move price, clear out all the orders that were set at these double bottoms, and then boom, take price to the next direction where they want it to go. And the same thing here. So they clear out every order here, and then boom. This is what we know to be liquidity. This is the traditional way of being liquidity. Okay, so liquidity, as I said, is money. Well, in terms of the structure that we trade or in the Forex market, liquidity is fuel. You know, a car needs fuel to move. So the same thing applies in Forex trading. All right. The institutional traders, they need fuel to move. Price candlesticks need fuel to move. Okay. For money to flow from one point to the other, money is needed. Do you know what I'm saying? So for the candlestick to keep moving, all right, And for supplies to be made, demands, money is being sent from one place to the other. Money is being transferred from support to resistance, supply and demand. We all need fuel. So you don't want to place your order where people are placing orders where it will be used as fuel, or else you will be used as what? Liquidity. So most of the times, the reason why we are stopped out is because we place our orders at points of liquidity or zones of high liquidity. High liquidity areas. Those are the places some traders, because they are not aware, they place orders in those zones or areas. So what happens? The market makers use their orders as what? Fuel to take price to another direction. So this is the traditional way of knowing liquidity. Okay, so I believe that we know the double tops and double bottoms. So as regards our strategy, we're going to be talking about different types of liquidity. Okay, types of liquidity. So let's look at types of liquidity. So we have, number one, we have transactional liquidity. Number two, we have structural liquidity. And number three, we have inducement liquidity. So I'm going to break this trade down, okay, using structure or chart. Okay, so we're going to draw structures here. So what is transactional liquidity? Transactional liquidity is the money transfer liquidity that is needed to move price, okay, in order to cause a shift in market structure. So for example, we have price. Example, we have price. We have this, the sweep, and then boom. Okay, so this shift, okay, this is our transactional liquidity. So we call it T liquidity. Okay, the price movement that swept the recent high of a downtrend, or the price movement that swept the recent low of an uptrend. It's called the transactional liquidity. So this is transactional liquidity. Okay. So this is transactional liquidity. The next one is the structural liquidity. So which is the structural liquidity? The structural liquidity is the form of liquidity that is being engineered by price or the market that will be used in the future as fuel, okay, to move price, okay, to either a supply zone or a demand zone. And also, it is the type of liquidity that is needed, okay, as fuel to take price from demand to supply. So let's look at it. So we have a price movement, we have a sweep, and then we have a transactional liquidity, and then we have the structural liquidity. Okay, so first we have the transactional. Okay, there's no need putting that because I just did that. So let's use it for, so this is your structural liquidity. So I'm going to put S dollar. So the same thing when the market is moving so we have this. We call it as liquidity. So this is our structural liquidity. Okay. The next one is the inducement liquidity. So what is the inducement liquidity? So in the absence of structural liquidity, market uses the recent point of liquidity point, okay, the recent liquidity point, okay, as a sweep. For example, what do I mean? In the absence of structural liquidity, we have inducement liquidity. So let me explain. So for example, we have this break of structure, sweep, and then we have the transactional liquidity. If there is no structural liquidity, price is going to use the sweep as the liquidity. Boom, and then start going up. So then this becomes your inducement liquidity. So let's say IDM, inducement. Also, in the same vein, we have this. In the absence of structural liquidity, price is going to do what? Use the sweep as liquidity. So we have IDM, inducement liquidity. Do you understand it? Let's go back. Number one, I said transactional liquidity. So this is transactional liquidity, okay? The price movement that sweeps the recent high or low depending on the trend of the market. And structural liquidity, which is the liquidity that is engineered by markets, okay? That will take price from a supply to a demand, that is needed as fuel to take price from a supply to a demand. Okay, and inducement liquidity is the liquidity. In the absence of structural liquidity, the sweeps becomes your inducement liquidity. So price is going to induce. So let's go back to our structure. So let's explain something. I want to explain something using the structure that we used yesterday. So for example, we have this, a sweep, okay? Usually with this, our model or strategy, we are expected to have all forms of liquidity in place, most especially the transactional liquidity and the structural liquidity. So at this point, we have the transactional liquidity, $T, and we also have our structural liquidity, which is S dollar. Okay, and remember, this is our break. For the strategy that we trade, break of structure, you can say BOF. For the strategy that we trade, with this, the main low is always protected. This main low is always protected. Take note of that. So we call it protected low. Okay? So what you as a trader using this model is expecting is that you're expecting price to come back, sweep the structural liquidity, okay, and then boom. Okay, but in the absence of structural liquidity, you don't want to trade because why? Structural liquidity is the liquidity that is needed, okay, that is usually engineered and will be used as fuel for moving price from either demand to supply or supply to demand. So that is how the market operates. So you don't want to trade if you don't see structural liquidity. So for example, you see a model or a structure such as this. Okay, you don't want to take that trade because this is not structural liquidity. What will happen is price is going to induce, take the main low, which was to be protected as what? The structural liquidity. And then what will happen? Boom. It will be induced. Okay? It will be induced. So this is what happens. We don't trade if we don't see structural liquidity. We only trade when we have our transactional, our structural liquidity in place. So in the absence of structural liquidity, you don't take that trade because price is going to use the main low as liquidity. Which is the main low? This is the main low. This is the main low. So the main low in this strategy, okay, is usually protected when you have a structural liquidity. But in the absence of structural liquidity, it is not protected. It becomes the liquidity itself. So if you see a structure like this, you don't want to take that trade. Already in your mind, you know that this is what you're expecting. Okay, and usually when things like this happen, price start buying very fast. You're going to see a long buy because why? It has swept it. But you don't want to be used as the liquidity. You don't want to take the trade if there is no structural liquidity. It is simple as A, B, C. If you can know this and understand what I'm saying, part of your problem is solved as a trader that trades structure using the Quasimodo, the Advanced Quasimodo. Okay, so you don't want to trade if there is no structural liquidity. Because the strategy that we trade, we need structural liquidity. It is part of the criteria that are needed, that is needed to trade this strategy. So you don't want to trade if you don't have structural liquidity. You always want to see that even though you have your transactional liquidity, your structural liquidity is in place. If that is in place, then it is sure that you're going to take that trade. That trade will definitely come to your demand or supply zone. Okay, so this is for a buy. Let's look also for a sell. So we have this. What will happen? Price will come, sweep the structural liquidity, and then boom. Okay, and then boom. So we have your structural liquidity as dollar. Okay, remember your high is always protected. Protected high. And also remember, in a case where you don't see structural liquidity, the recent or the main high will be used, the main high will be used as what? The structural liquidity. Sorry. Let's see. And then what happens? Boom. So what happens here? We have this becomes inducement. Okay. So you don't want to trade this. You also don't want to take a trade that looks like this. The moment you see that there is no structural liquidity, already you save yourself from losses or from blowing your account. When you see things like this, you save yourself from what? Blowing your account or from losses. Okay. So you just save yourself from bad trades. What you want to see and trade is this. These are the things you want to see and trade. You want to see structural liquidity. You want to see as a trader using this strategy. You want to see transactional structural liquidity. In the absence of structural liquidity, you don't want to take that trade. And if you understand, kindly go to the comment section, say I do. Before I move on, go to the comment section, type I do. I do understand. Great. Great. Go to the comment section, keep typing I do. Now, okay. Now, there is another form of liquidity called the engineered liquidity. Okay, so I'm going to explain that right now. The engineered liquidity. Okay, now, usually, remember, you need structural liquidity to trade this strategy. So sometimes, if price doesn't give you or give us a structural liquidity before going up or down, depending on the direction of the market, okay, sometimes the market or price engineers a liquidity while it's either going down or is selling. For example, let me give you an example. So let's say we have this, okay? Normally, according to this strategy, you're supposed to have a structural liquidity here, okay? But sometimes you're not going to see this structural liquidity here. What price will do is price is going to play things like this. Okay. And then start coming down. Now, what happens is this, price will then engineer liquidity, okay, around here. Okay. And then boom. So then how do you know that it is an engineered liquidity? Now I'm going to show you a secret. How do you know that this is an engineered liquidity? Remember, we are supposed to see structural liquidity here. So this is not a structural liquidity. This point here is not a structural liquidity. Okay? But you're supposed to see a structural liquidity here close to the demand zone before we can take that trade after experiencing a market structure shift. Okay. But in the absence of structural liquidity, remember, always expect an inducement liquidity. But while you're expecting an inducement liquidity, if that zone, that price gave this structure is a strong zone, example, is a supply or a demand zone, always expect an engineered liquidity, except that zone is not a supply or a demand zone. If it is not a supply or a demand zone, don't expect an engineered liquidity. Just know that there is going to be an inducement liquidity. That means the main low will be used as the liquidity itself. So the main low will be swept. But if price or structure is coming from a key or higher time supply or demand zone, for example, if price is coming, this structure is coming from a higher time or demand, okay? Don't expect an inducement liquidity. Expect an engineered liquidity in the absence of structural liquidity. So, what are the signs that tells you that this is an engineered liquidity? Usually, okay, when price is coming down, take note of this. When price is coming down like this, take note. For you to know that that is an inducement liquidity, the liquidity point will be protected. For example, it will be protected like this. And then it will give you a structural liquidity kind of form. Okay. All right. And then it will sweep this and then boom. What does that mean? This point will be protected. Normally, you're supposed to, this low, okay, because it's trending, because the market is trending downward. So this low normally is supposed to come down, sweeping this, but it won't. It's going to protect it. Okay? It's going to come somewhere here or sometimes around here. Okay? When you see something like this, know that that point is an engineered liquidity. Market has given you an engineered liquidity. So all you have to do is to what? Buy. So this is how to spot an engineered liquidity. Okay, so I'm going to show you from a live chart. Okay, let's see this engineered liquidity from a live chart. So let's look at this pair. Let's look at this pair. Okay, let's look at this pair. So we can see here, okay, we can see what price is doing here, okay. So let's forget about these points. So we're going to forget about this point, okay. So I just want you to look at this other side. This is where we're going to be looking at, okay. So you can see that this market was actually, this is 2 hours chart. So you can see that this market was trending up, okay? And then what did I say? You're expecting a structural liquidity. Let's assume that maybe we're expecting this to form something like this, okay? And then boom, all right? A liquidity that is obvious, but then you didn't see it, and then we start seeing things like this. And then what happens? Market engineer the liquidity, okay? But I want you to notice something. Can you see that this price movement did not sweep this low or the week? Rather, it came somewhere here and then start playing around. And then what happened eventually? It swept, touched the inverse value gap, and then boom. Can you see that? This is an engineered liquidity. This is exactly an engineered liquidity of what I'm explaining to you. So once you see things like this, just know and make sure that where the origin, okay, the origin of price is coming from a demand, a higher time frame demand or a strong demand. Because once price is moving from a demand like this, we're expecting price to buy long. But since price hasn't bought long, price is going to come back, okay, and then clear that engineer liquidity. But before price will come back, price is going to engineer liquidity for you as a trader that you're going to use. So your eyes need to be open to see ahead what's going to be happening in the market. Do you understand what I'm saying? So this is an engineered liquidity. Can you see it? Market engineered liquidity along the line, okay? Because why? We didn't have structural liquidity, okay? We were expecting price to give us a structural liquidity. That would be obvious, okay? But it wasn't obvious. So you can see what price did. This is what price did. And we can't use this as a valid liquidity point, okay? Because it's not okay. So we can't use that, okay? So this is a live example, all right? So let's continue. So do you see what I just explained to you? So this is engineered liquidity. Always remember this. And always put in your mind that you need structural liquidity. If you don't see structural liquidity, you're not going to take that trade, okay? So now let's look at the criteria for a valid structural liquidity or engineered liquidity. Criteria for a valid structural liquidity or engineered liquidity. Okay. Number one criteria is it must be A or V shaped. Number two, it must be at least 50% at least 50% of fee retracement. I'm going to explain that, okay? It must be A or V shaped. It must be at least 50% of field retracement. So for a buy, you're going to say, 50%, okay, let's say from transactional liquidity to the main low. I'm going to explain, but just take the note. For a sell from the main high to transactional liquidity. So what do I mean? I'm going to explain. So for a bullish structure, so we have a bullish structure here. And then you have a structural liquidity. Okay. So how do you know that this is valid? How are you going to tell that this liquidity, which is the structural liquidity, is valid? So you're going to, first of all, what is the criteria? It must be A-shaped or V-shaped. So for a buy, it must be A-shaped. So what is A-shaped? You know what A is. So this is A-shaped. In other words, it must be obvious. It must be obvious. If it is not obvious, it is not a liquidity. It is not a structural liquidity. It must be obvious. Okay? So for this right now, the structure we see that I just drew, it is obvious. But then, what is the next criteria? Second said, it must be at least 50% of fee retracement. So how do you measure your fee retracement? For a buy, okay, from transactional liquidity, you place your fee from the transactional liquidity point to the main low. So for a buy, we're going to pick up our fee retracement tool, place it at the transactional liquidity. Remember, this is transactional liquidity, and then we take it toward the main low. So at least it must be at 50% of the fee retracement. So can you see that it's at 50% of the fee retracement? So it's either is exactly at the fee 50% or at least, sorry, not at least 50% or below the 50% line, which is the discount zone. You said that it's at the 50 or at the discount zone. Then we can say it's a valid structural liquidity. But when you see a structural liquidity that is far above the 50%, you don't want to take that trade. It is not valid. So therefore, you won't take that trade. Do you understand? Just because you saw this doesn't mean that you have to take that trade. You have to measure it to be sure that the liquidity is at 50% or at the discount zone. Remember your fee retracement. Remember your fee. So we have on your feed, we have this zone. So the 50 is what? Premium. Okay, the 50 is your equilibrium. Then from 50 down is what? Your discount. Discount. So usually people buy low to sell high. You don't buy high to sell low. You won't make profits. So the same reason, like you went to the market to buy, let me say, shoes. You buy low to sell high. If you buy a shoe for $10, you go back and you sell, let's say, $20 or $30 or $25 to make profit. So the same thing happens, that people, that price or traders usually buy at discount. And what do? They sell at premium. Okay. So that is why you need to measure. Do you understand this? That's why you need to measure your structural liquidity, because you need fuel. Fuel is needed, and that fuel must be at the exact point where it is needed to be. Okay, so the structural liquidity itself must be at the 50%, not far above the 50%. It could be slightly. Can you see things like this? But if it is somewhere here, you don't want to take that trade. It is not valid. It is not what? Valid. So it is either at least, remember that word, at least. That means the lowest it should be is 50. But what you're expecting is this structural liquidity should be at the discount zone. But the lowest, the least of all is 50%. If it is not 50%, it is not valid. Okay? So if you understand this, then you're good to go. So the same thing with a sell. Sorry. So the same thing with a sell. So what is the first criteria? It says it must be A or V shape. So for a sell, it must be V shape. That means your liquidity, okay, must be obvious. Remember your V. If you went to school, you should be able to know that this is V. Obvious. Your eye should see it, okay? If you're not seeing it, then it is not liquidity. So what happens? The second rule says it must be at least 50% of fee retracement. Now, this is a sell structure. So what are you looking for? You say for a sell, you measure from the main high to the transactional liquidity. So this is what you do. You take your fib tool, measure from the high to what? Let's keep it here. Okay, so can you see that? It must be 50 or at the premium, okay? So you measure, once you measure this, then what do? You look at your liquidity. Is it at the 50, at least at the 50, or is at the premium? So is either is at the 50, the least is 50, or is at the premium. If it is at 50, it is valid. If it is at premium, it's valid. But if this liquidity is far, it's not valid. You don't want to take that trade because it's far. For example, we have things like this. This is not a valid structure, so you don't want to take that trade. So price is going to induce you, use your main high as liquidity, and then boom. Can you see? So that's why you want to make sure that your liquidity is at least 50. Okay? Is at least 50. So once you get this done, then you wait for price. Once you measure this, what do? You wait for price to come, boom. And that's it. Wait for price to come, boom. This is it. Do we have any question? Do you have any questions? If you have any question, you can raise your hand. You can raise your hand in the chat box. Use the hand tool if you have a question that you want to ask. If you have any question, please, let's be fast. For those of us who have questions, if you understand, you can say, I do understand. But if you have a question, raise your hand. Okay. Okay. Shawa said, given that price is fractional, can we use this same approach to get intraday setup? Yeah, good. This approach, okay, is used for. So I'm gonna today. Let me give the time frames that we use. Okay, so let me quickly give the time frames that we use. The time frames that we use the strategy for. Okay. Time frames for the Advanced Quasimodo. So we trade the number one, we use the higher time frame. So for example, we have the 1 hour, 2 hours, 3 hours, and 4 hours. So that means you can trade this strategy when you see a structure in the 1 hour, 2 hours, 3 hours, 4 hours. Okay, you can see a structure in 4 hours, you take the trade. Okay, and mid time frame. Mid time frames. 30 minutes and 45 minutes. These are the only time frames that we trade. Okay, then you can check for your directional bias. Okay. Using the 4 hours. Daily and also weekly. Okay, so the Quasimodo, why? Why? Because this strategy works best at higher time frames, not lower time frames. Okay, it works best at higher time frame, not lower time frame. Example, five minutes, sorry. Example, 5 minutes and 15 minutes. So you want to avoid trading this strategy on 5 minutes and 15 minutes. Never do it. Never do it. Trade the strategy, the mid time frame, 30 minutes, 45 minutes, 1 hour, 2 hours, 3 hours, 4 hours. Okay, so I'm speaking based from experience. I never take a trade from 5 minutes, 15 minutes. It is not a scalping strategy. Okay, it's a day trading or swing trading strategy, and it's a price action based strategy. So you don't want to trade this strategy on a lower time frame. Each time you have a urge, maybe you see the setup on a lower time frame, the urge comes, kill that urge. Don't take that trade. Even if later you saw that it worked out, don't be tempted, because the higher time frames, okay, once structure is formed at the higher time frames, it takes a longer time. Any structure that is formed on a higher time frame, okay, gives an assurance that it will hold as far as the criteria are correct. Okay, it gives you this assurance that this thing is going to hold as far as you know what you are doing and the criteria that you have for that strategy, okay, aligns with it. All right, then it's going to hold at least 60 to 90% that is going to hold. So you don't want to gamble with the money that you have. You want to trade and have an hedge in your trading skill or in your trading profession. You don't want to gamble. So for you not to gamble, avoid trading this strategy on the 5 minutes, 15 minutes. Rather, trade it on 30 minutes, 45 minutes, 1 hour, 2 hours, 3 hours. So you can also trade it in 4 hours. If you see the structure in 4 hours, you can trade it. Okay? All right? So any other question? The fib retracement settings. Okay, I'm going to show you the fib retracement settings. So this is my fib retracement settings. So this is my fib retracement settings. So can you see it? So that's my fib retracement settings. If you have just seen the fib retracement setting, then let's see. Okay, thanks. I understand. So finding the higher time frame narrative, then I will not know. Okay, good. Do we have any other question? Do we have any other question? Do we have any other question? In the absence of any other question, I want to ask the last question myself. Do we all understand what was taught on liquidity? If you do, go to the comment section, say yes. Do we all understand what I just explained about liquidity? Thank you. Please go to the comment section. We are about 20-something here in this group. Go to the comment section. Okay, good. So in the absence of any other question, we're going to end the class here today. We're going to end the class here today. Okay? And then tomorrow we'll be coming back. We'll be coming back here tomorrow, and I will be teaching on supply and demand. And if there's time, I'm going to talk about resistance and support, okay? That aligns with this strategy, okay? So don't miss it. Share the link with friends. Join my Telegram group. Join our Telegram our channels, okay? Subscribe to the YouTube channel. For those of you who have not watched yesterday, the first day video, go to my YouTube channel, Earldasothebrand. Just go there, click on the link that has been shared. Go and watch the YouTube video, okay? Learn from there. Go to day 1 so that you can understand better day 2, all right? And now the assignment I have for you guys is go to your chart and identify, measure your liquidities. Use the fib retracement tool, measure your liquidity. Go to your chart, light chart, measure. Start looking, start training your eyes to see structures, okay? And as you do that, you're going to make huge progress, all right? Okay, I said something. Yes, I clearly understand because I have prior knowledge, but not this clear. Okay, great job, Shaba. Good to hear that. Good to hear that. But some people have started making money from the strategy, from just a few things I taught. So that's amazing. So good to have you guys. Bye. See you in the next class tomorrow.